The International Energy Agency just called this the greatest global energy security challenge in history. Not a recession warning, not a rate hike, in history. Oil above $100 a barrel. The Strait of Hormuz, which carries about 20% of the world's seaborne oil, barely functioning. Stock markets down globally. Supply chains already starting to seize up. And the Fed, which was supposed to cut rates this year, is now sitting on its hands, watching inflation tick back up. And somewhere in the middle of all that, you've got rent due, a grocery bill that's somehow worse than last month, and a portfolio that looks like it's having a rough week. So, what do you actually do? That's what this is. Not panic, not doom, a playbook for right now on how to not get wrecked by something you didn't start and can't stop. Let's establish what we're dealing with, because half the battle is not getting swept up in whatever the loudest headline is today. The Iran war, the US and Israel strikes that started in late February, closed off the Strait of Hormuz. That's a narrow channel, and a staggering amount of the world's oil moves through it. When that channel gets disrupted, energy prices spike globally, immediately. Brent crude jumped over 10% in the first days. It crossed $100 a barrel not long after. Here's the thing about oil prices most people don't track. They don't just hit you at the gas pump. They hit everything. Fuel goes up, so trucking costs go up. So grocery prices go up, so heating bills go up. The economists call it pass-through. You just feel it as everything is more expensive again. The Fed, which had been signaling rate cuts in 2026, is now in wait-and-see mode. Goldman Sachs is penciling in cuts later in the year, maybe September, maybe December. Some market pricing pushes it out even further, to mid-2027. That matters because higher rates for longer means borrowing stays expensive, the housing market stays locked, and growth stays sluggish. So you've got higher energy prices, higher food prices, higher rates, slower growth, wobbly markets. That's the environment. Now, what do you do in it? Do not sell everything. I know that sounds obvious. But when markets drop and the news is loud, the instinct is to protect what you have by cashing out. Get to safety, wait for the smoke to clear. And historically, that's the move that costs people the most. Look at the pattern. 2008 financial crisis. The S&P 500 lost about 50%. The people who sold at the bottom and waited for certainty before getting back in, they missed the entire recovery. The people who held or kept buying came out ahead. COVID, March 2020. Markets dropped 34% in 5 weeks. 5 weeks. Then recovered everything and hit new highs within months. The 1970s oil crisis. Economists at the time were calling it the end of the post-war economic model. The market recovered. It always has. This doesn't mean the current situation isn't serious. It is. The IMF revised global growth forecasts down and inflation forecasts up. That's real. But serious is not the same as permanent. And the mistake of panic selling during a war-driven shock, that's very close to permanent, because you lock in the loss and then miss the rebound. The Chatham House economists put it plainly. If the conflict wraps up in a matter of weeks, the impact on GDP and inflation for most advanced economies is limited. If it drags, it gets harder. But either way, selling now is pricing in the worst case and surrendering the upside if it doesn't happen. All right, concrete moves. First, your existing investments. Leave them. Don't log in every day to watch the number. That is not a productive activity. Set a calendar reminder. Check once a week, and otherwise let the position do what it's going to do. Second, if you are already dollar cost averaging, keep going. Especially keep going. A down market means your fixed weekly or monthly buy gets more of the asset per dollar. That's not a consolation prize, that's the actual mechanism by which long-term wealth gets built, buying more units when the price is lower, accumulating through the dip. We covered this in episode 1 with Bitcoin specifically, the fixed supply, the inflation hedge argument. And that thesis doesn't get weaker when inflation is being driven up by an energy war. If anything, it gets stronger. The dollar is losing purchasing power right now in real time. An asset with a hard cap of 21 million units is the opposite of that problem. Third, if you're not invested yet and you've been waiting for a good entry point, I want to be careful here because nothing I say is financial advice, and war-driven volatility is genuinely hard to call. But historically, sharp market drops driven by external shocks rather than fundamental business failures have represented buying opportunities for patient, long-term investors. That's not me telling you to go all in. That's me saying the logic of long-term investing doesn't disappear in a downturn. It's actually when it matters most. Now the boring stuff, which is also the important stuff. Your grocery bill is going up. Your fuel is going up. That's already happening, and it's going to persist for as long as the energy disruption lasts. So you need to do a fast audit of where your money is going. Not a complicated one, 20 minutes with your bank app, and identify what's variable versus fixed. Subscriptions you forgot about. Takeout that's become a default rather than a choice. Gym membership you use twice a month. These aren't the cause of anyone's financial stress on their own. But right now, with costs rising in categories you can't control, you want to free up buffer in the categories you can. Cut the optional, protect the margin. Emergency fund. If you don't have one, this is the moment to understand why it exists. 3 to 6 months of essential expenses, liquid, sitting in a high-yield savings account. Not investments, not crypto, cash, accessible, earning something while it waits. That fund is the reason you don't have to make desperate financial decisions, like selling investments at a loss when something unexpected hits. And right now, things are hitting. On fuel specifically, there are ways to be smarter about it. Gas prices don't move uniformly. They vary by station, by day, by region. Apps like Gas Buddy exist for exactly this. If you're driving a lot, the price difference per fill-up adds up fast across a month. Small thing, real saving. And if you haven't already started a side income, now is the moment. Not because the economy is going to fall apart, but because the people who come out of economic volatility ahead are the ones who had multiple income streams going into it. Even a small one, freelance work, reselling, tutoring, a digital product, something that isn't fully dependent on one employer in one industry. That's not paranoia, that's just how risk works. Here's what I want to leave you with before the final piece. This situation, war, inflation, energy shock, market drops, it's genuinely stressful. And it's okay to feel that. The system wasn't exactly stable before this started. You were already dealing with post-pandemic inflation, tariff pressures, a housing market that locked most people out, and wages that haven't kept pace. And now this lands on top of it. But here's the thing about every previous version of this. The 1970s oil crisis, 2008, COVID. The people who kept their heads and kept building, even slowly, even imperfectly, came out of it with more than they went in with. Not because they were lucky, because they didn't let fear make the decisions. The question isn't whether the economy is hard right now. It is. The question is what you're doing with that information. Drop a comment. Are you staying in, staying calm, or are you genuinely worried about where this is heading? I want to know where people actually are right now. One more thing worth knowing, and this gets buried under the global panic headlines, the US is actually more insulated from this than most. The US is now a net energy exporter. That means higher oil prices, while painful at the pump, don't hollow out the US economy the way they hollow out Europe or Asia, both of which rely heavily on Middle Eastern fuel. Europe is facing a possible technical recession. Asia, China especially, importing around 10 million barrels of oil a day, is getting hit harder. The US dollar hasn't lost its global reserve status through this. US defense and energy corporations are among the financial winners of this situation. And Goldman Sachs, for whatever their forecasts are worth, is still penciling in rate cuts by late 2026, which would be a tailwind for markets. None of that makes your grocery bill easier right now, but it's context. You're not in the worst position in the world to be navigating this, and you're not doing it without a playbook. Recap. Don't panic sell. Keep DCAing. Audit your variable expenses. Build or top up your emergency fund. Start a side income if you haven't. And stop checking your portfolio every 12 hours. It's not helping. This moment is loud, but loud moments have a history of passing. And the people who built through them are always glad they didn't stop. Stack smart.